ahas that you've had so far?
But I'm so glad I came.
Well, oh, good, I'm glad you came. Anybody have anything that's a big aha to them that they think they can use?
I think for a lot of people, they don't realize that it exists, so they can't do it.
Yeah.
Like,
Say that
a
again?
lot of people don't realize that it's an option.
That it's an
for
option.
them
Yeah.
When they're selling a house, because it's been so easy to sell a house lately.
Yeah, you put a sign in the yard, ask the national
Yeah.
news that said you stick a sign in the yard and that's all you have to do. No, not very good advertising for us. So, okay, you had, I saw the
Well,
wheels.
So I was texting a lender that I know to ask her whether or not a certain loan that we use is assumable, and she said no, and I'm asking her, like, are you sure? Like, because she
say-
may not know, right?
Well, and
Like,
what you need to do is say, does it have a due on sale
yeah,
clause in it?
literally just typing that in as you
Okay,
said.
yeah.
When I was talking to Tony, with US Bank at the Oklahoma event, and he said he's actually helping somebody with a VA assumable right now. So he
Good.
said it's the very first one in over 20 years of being
Huh.
in business.
Wow.
Yeah.
It's been a while.
Interesting.
I love these because I really feel like it's a fantastic opportunity for us to keep our market going. However, what do we have to do to get them in the marketplace? We as realtors have to be educated and ask the questions at the time of listing. And so that's why I'm super excited that we have this many here. I've got almost 40 in the class tonight. So, you know, the more that everybody gets on board with it, then when you make that phone call, they're up going, well, you can't do that. I don't know. So anyway,
And I think it's a great way to work buyers that we feel like are stepping out of the market because interest rates are climbing. It's a great way to go after them and realize, and make them realize you can still do this.
yeah, if you have a little bit of money,
Yeah.
you can still do it. Because if they've only lived in it a year or two, not every part of the market has gone up 37%. There's some of them that are 4 and 5 that make it doable, and we have sellers that are just trying to get out of them for the cost of selling it. And those buyers we haven't priced out of the market if they've got those 2 and 2 1/4, 2.5 interest rates.
Is there ever an option on these if they don't have enough cash for?
We're gonna go there right now. Thank you. I appreciate that lead in.
That's where that financing gets super creative.
Yeah, so the next thing that you have is seller finance. Is that in your paperwork?
No.
Did I give that to you? Okay, so there's this little addendum. It's called seller financing. Okay? You can do a seller finance for part of the equity. So if the buyer only has enough money to pay the cost to get it to closing, which would be the list of seller's cost here, the seller could carry a second mortgage and get that paid out over time. Now the buyer has to qualify with that second. So it becomes one of their debts on their application to the lender for the assumption. So say we have our scenario that we've talked about here with the $50,000 equity. How much did anybody add up what the seller's cost were going to be on there for me? Wouldn't it be about 15, 18,000, something like that maybe? So say the buyer has 20,000, our equity's 50, the seller could carry back 30,000 for 5, 10, 15 years. And if they haven't lived in it 2 of the last 5 years, they defer out their capital gain. Ever thought about that? Because if they haven't lived in it 2 of the last 5 years, they could potentially have a gain on that sale.
But if they sell or finance it, then
If they sell or finance part of that equity, they're stretching it out over the term of that payback. And on a seller finance, there's no prepayment penalty if they win the lottery and they pay that off early. Okay? I will also tell you, locally, there's not many lenders that will do a second. However, I talked to Chris Price at Price Mortgage in Edmond yesterday. He will do a second. I'll give you his number. And again, you're going to have a little bit of closing cost on that second.
Then is there a required appraisal?
It depends on how you do it. There may be on that second to do it that way. On an owner carry, no.
Right.
It's going to depend on where you get it. Credit union, a bank, a lender, they might, however, they might not. They may just pull current records and see what it shows and go from that, depending on, what the debt to income is and what the equity actually is on it. His number's 405-413-5427. Now, I don't do advertising, I'm just telling you I found one that would do it, and I said I'm sharing your name and number, and
Can you do the example, like the number example again for that?
so say you were needing, the buyer only has $20,000.
And the equity was 50K.
The equity's 50 plus the closing cost. So we're saying, I don't remember what we came up with, and I'm
So
just gonna say it's
30K plus closing that they have to come up with.
right. There's 30,000 plus the closing cost, and they only have 20. The difference of that, the seller can carry as a second, or they can do a second mortgage.
So the seller puts the lien on the house.
The seller has a second, yes.
Not
Mhm.
primary, but
They have a second mortgage on it. So if the buyer goes to sell it, the seller's gonna get paid. Is there some risk in that? Yes, because there's a second. The buyer still's got a pretty good chunk of money allocated because they had to come up with the 15 to 20 to pay the cost of sale. However, we have quite a few buyers out there that still have some money. They just froze because of rates. Thaw them out and sell them in equity. I mean, truly, it's a fabulous product. And when you pull these listings up that maybe meet their criteria, you can go into the tax record, you can see when they bought it, and call and ask the listing realtor the questions. They're not gonna know the answer, but you can call and ask them and tell them to find out, and they may know them. But help them, because when you help them, what are you doing? You're helping your buyer. Maybe find a house that they wouldn't possibly find in some of those that have been on the market 10 to 45 days now that they're going, why hadn't it sold? Okay? So those are other ways, if you don't have the full equity, you can still make that happen. Kind of cool, huh?
It is cool.
It's really technical. Makes you really rock star of a realtor, and I like rock star realtors, trust me. Because knowledge is power, right? And how powerful does it make you to be able to do this?
You're kind of like a real estate god.
Well, it helps your arsenal, I mean, it really does. And when you go on that listing and that seller's interviewing 3 people and you're the only one that does it, who's going to win that listing? It's not going to be the one that says, I'm going to put a sign out there and we'll get it done in 4 days. It's going to be the one that gives them some options to get the most out of the property. Okay? All right, so how many of y'all like VA loans? I'm just going to tell you, it is the most underrated, sad product on the market today. And I last year served on the Federal Issues Committee at NAR, and veteran loans were our topic every meeting because they're at such a inequality when it comes to winning an offer.
Absolutely.
Because sellers don't understand, realtors don't promote them, and they get beat out every time. Well, let me tell you what, they're the most solid buyer there is. Because if they don't make the payment, they don't get their tax return, they don't get their military retirement until that's paid if they go bad on a loan. So they have a lot at stake when it comes to a VA loan. And I'll tell you, and I am sure most of you all probably know that, know the changes that conventional has made. As of April, their appraisals are just like FHA. No more bare floors.
Yep.
You better make sure it's painted. You can't do, their guidelines now on a conventional are the exact same as an FHA on an appraisal.
This is
So-
new to me.
Hmm?
That's new to me. I didn't know
Oh,
that.
glad you
Since
came to
when?
class. April.
What
After
guideline
I
was
cross
that
it.
changed? Or is that on the appraisal board or what
It was a
that?
national requirement that was done by, that all conventional appraisers have to go by now. It changed their guidelines.
Okay.
Yeah, I got
Glad
a
you came
few
to class today, right?
requirements for conventional.
You're getting requirements.
Yeah.
No more
Really?
no more bare floors. You gotta have carpeting or stained or painted floors.
Where, so that originated from where? Was that the
It's the national, it came through Freddie Mac and Fannie Mae. It's new appraisal requirements as of April of this year. They're the same as FHA. Because they've been loaning on stuff that now with the 2.5 million foreclosures in the system, and there's 1.5 of those are getting ready to hit the market in the next 3 months. Are you ready?
Already starting to hit.
And the other 1.5 million will be here before this time next year. They're seeing that some of the stuff that they've loaned on is just stuff. And, you know, and I'm way off topic here. However, if any of you all have ever sold a mobile home, you know why you surrender the title now? Because back in the 80s, they loaned on them. And when they foreclosed, they went out to look at it and all they had was the land. Because they sold the trailer off or pulled it off and went on packing down the road. Well, now you can't do it with, nobody can move them without a title in hand. So that's where that came from. So as things happen, we see changes in our industry. We're going to see some more changes in some guidelines with some things like that because of what's been going on in the last 2 years. So just be prepared and stay on top of that. Okay? So, VA is coming up. However, we as realtors have to educate our sellers. They're really a good loan. Yeah, they're going to be a little picky, but they're not any more picky now than an FHA or a conventional appraisal. And we're raising Cain with our legislators at a national level to get this appraisal thing where they can go staff like FHA and conventional. We're also working on the flip rule, getting rid of the flip where you got to hold it so long to get it sold without the double appraisals and those kinds of things. All these changes are coming for the good of our industry. So on a VA, you have a qualifying assumption, just like we have on USDA. He's looking at me like I just learned something that's just making my head swim. He's like, I'm going down here with something. I can see it spinning in his head. So FHA, conventional, USDA, all of those are assumable. A VA is assumable the exact same way. They require a release of liability to the seller before or at closing. Now, on a VA, if you'll look in paragraph 5 of the equity assumption page, which is the second page. A says VA approved release of liability is required prior to closing, which is that letter that we talked about getting, right? B says VA approved substitution of entitlement is or is not required by this contract to close.
Where are you?
I'm on the equity assumption page, assumption of loan. The second page of that, which should be about 5 pages back, I think.
It's the last page of the packet.
Oh, last page of the packet. Okay. So, this is really, really, really important that you understand the difference here. When a veteran does a VA loan, they use their eligibility or their entitlement. And it takes a certain amount based on the sales price of the property. If they sell the house on an equity assumption, they could potentially still have enough to use it again. However, you need to, in my opinion, protect that seller. The only way, or help him protect himself, I should say. The only way you can do that is with a substitution of eligibility, which that means it must be bought by a VA buyer. They take their eligibility and they put it in place of the seller's, and the seller is fully released.
And still has their eligibility to go on.
They can go and do their second purchase, third purchase, whatever. That's correct. Now, why this is so important, and I really stress this because not every VA seller is going to know it. However, you need to educate them, and when you have that listing, who are you obligated to? The seller, right? So, if they don't do the substitution of eligibility, and that loan goes into foreclosure, they will go after the veteran. They will take their tax return. They will take their disability. They will take their military retirement until that deficiency is paid back. It will haunt them till the day that's paid back. And the problem is they don't go and find Mr. Seller at 5 years ago and say your loan is in default. Do you want to catch it up? Because they don't have the ability to catch it up anymore. It's not theirs to catch up. So their entitlement is out here with them still liable under that. I personally wouldn't do it. You're going to have some VA sellers that just say, I got to go, I got to get out of here, I'm going to take the risk. If they're putting $75,000 down, they're not real likely to walk away. They are pretty likely to be able to sell it and get their equity out of it. Or the lender's not going to have a shortage when they sell it and come after me. If that equity's big enough, the seller may say, okay, I'm telling you, I'm going to tell them all the horror stories I know and all the things that could happen, and ultimately they make that decision. Okay? Educate, educate, educate.
So on that, the way to protect them is to make it where the substitution of entitlement is required.
Is required. Which in that, in my remarks in MLS, till Angelina gets the fields added for us.
You didn't email me.
I know, I haven't yet, because I'm still working on all of them. I'm like, every time I think of something, I'm like, we need that field too.
I told you to email me.
I know. That's why I said it's a work in progress.
Our R&D meeting's coming up quick, I think.
Okay, well, I'll get them to you after tonight, I
Yeah, you
promise.
can send them to Lydia too.
Okay, I'll get them
I want to,
after today.
verify something, just like it just
Okay,
reads.
let
So
me answer her really quick.
Oh,
Okay?
sorry, I
No,
interrupted.
you're
Oh,
okay.
Okay.
So in doing that, you've got to make sure at the time of listing that if they want that entitlement done, you put in those first two remarks, loan is assumable, must be assumed by a veteran with the substitution of eligibility. Disclose, disclose, disclose on the front end. Now, that doesn't mean you're not going to get an offer that they don't want to do it. It's up to the seller there again at that point. So, okay, go ahead.
So on that, so so a non-veteran can assume a VA loan, correct?
That's correct.
So, but if they're to do that, they're not going to assign the, what was it called, benefit or the
The
entitlement?
entitlement.
So they can't do that. The seller has no option to sign over that to the non-VA borrower on a VA loan.
The entitlement would stay tied up of the seller until that loan is paid off or refinanced or goes away.
But that's the risk.
That's the huge
So
risk.
on assuming VA loans, if we're protecting our sellers, we're going to have to put it in the remarks that we are only to protect our sellers, we are only
Seller,
entertaining
yes.
assumable loans to VA eligible buyers.
And what does that
With the
do?
substitute, okay.
What does that do? We just opened the market up to these VA buyers that haven't been able to buy a house because they keep getting outbid and they have money. What an opportunity.
And just to make sure, this is on the same note, so just to make sure I'm understanding that right,
Mhm.
like, because we're gonna sell our house soon, and we currently have a VA loan.
Okay?
But if we wanted to use my husband's VA benefit on our next property, we would have to sell our current home to a VA to still have that.
Okay.
If
Not-
we did an assumable. on
Not
our house.
necessarily. You
Oh.
could still have enough eligibility to purchase another. However, if you want fully released and it doesn't hang over your head until it's paid off, and you don't want to worry about his retirement and his benefits and your tax return, you want to make sure you get a substitution of eligibility.
Okay.
Yes.
That's what I thought.
Yeah.
Just making sure.
Yeah.
Thank you.
Yeah, and the thing about that, you can use your VA eligibility more than once. You have enough sometimes, depending on the sales price, to have more than one VA out there. However, don't. Put yourself. And Angelina and I were talking about Jeff Elias. There's a loan that I'm telling you, it's probably gonna come back. It's an FHA VA preference. And it's for people that have their stuff tied up and they get a reduced down payment on an FHA. I asked the lender the other day and they looked at me with deer in the headlights because they haven't been around long enough to know what that is. However, there's some products out there, and what that is a veteran can go in and do an FHA with a reduced down payment because they have VA eligibility. So I've been pushing to get somebody to bring that back into our market because it's an awesome loan. They get like half of the required FHA down payment. So as we get some of those products back in, we're going to see some big changes in financing. And that's why, you know, to me, if you know your financing, you'll survive the real estate market in the next 3 years.
What was the point of that? VA?
It's an FHA VA preference.
Why wouldn't you just do a VA?
Because they may not have full entitlement. It could be tied up with an equity or something. They could have a house that they bought as their primary residence and they rented it out and they have it as a rental and they want to use the rest of their VA. And they still own that. So there's all kinds of scenarios there that could allow for that.
Okay.
And that updates like every year with entitlement and per state too.
The entitlement does change by state and the cost of living and whether you were reserved, some of those affect your funding fee. Now if you have any disability over 10%, you don't have one. I'm not a lender, I just tell you the things we deal with every day. There's lots of benefits in a VA loan. This to me is a huge way for us to get some of these veterans that came here, transferred in, or are still sitting there, have sold houses, done different things, that have $20,000 or $30,000 that didn't want to do appraisal gaps, that have an equity, that could go buy a friggin' house at a 2.5% interest rate and go, ha ha on you, you didn't take my offer. And be in a much better position than they would be today. Jeannie, do you have something?
I think I'm slowly grasping this, because you lead me to another question, your question. So if we're talking with our sellers, and that risk of the liability or the eligibility,
Mhm.
which stays with them until it's paid off, correct?
If they
So-
don't do the
If they
substitution.
don't do the substitution.
That's correct.
So, you know, an offer comes in and they're not a VA veteran, they can't qualify for a VA loan. The seller then can have the option to not do an assumable. I
They
mean,
could counter
Their
it.
options are still on the table
Yes.
to choose what type of program they wanna, or how they wanna
And the
sell.
equity may be big enough that they take the risk.
Yeah.
It depends.
So then my second one, you were talking about, property being tied up and then having a rental. Does that include, like, if you marry into veteran status? For example, I had a house in Texas prior to marriage.
The veteran entitlement belongs to the veteran.
That's it. So my property that I owned prior to marriage does not affect his eligibility.
The eligibility belongs to the veteran, doesn't affect them in any way. Mm-mm. Okay? So, with that, do you see the importance? Now, I'm just gonna tell you, how many of you all are part of the Oklahoma City Facebook group that's so fantastic?
They're
Okay.
not allowed to post anything but asking for vendors though. if they're
Okay.
buying from.
All right, I mean, I'm in there,
There's
that's how we promoted this class. I mean, I sit there and cringe and say, code of ethics, antitrust, all the time. But anyway, you will see in the post that Angelina and I made on Richard Mize, is this really going on? She tagged me, because we had already been talking about this class actually, because I had taught it before. And somebody in there says you have to be a veteran to do it. It's this article. You can't do it unless you are. Well, I'm just going to tell you, I called VA Direct yesterday. I have a telephone number. If you ever get questioned on this, you text me and I'll give you my number before you leave today. And you can call VA and you can verify. You do not have to be a veteran to do this. However, to do the substitution of eligibility, you do. So if somebody wants to go rodeo roping with you on it, call me. I'd love to go along for the ride. I mean, stuff like that, it to me is, if I can document it, then I'm good with it. If I can't, then I'm going to step aside and I'm going to watch and see how it all plays out.
Yeah, I think
And
Richard
so-
Mize article had some things that were incorrect inside.
Oh, imagine that.
I read
Anyway.
it, I read it, and I was like, I don't think that's correct, but I didn't.
Yeah. So that's why I didn't do an interview with him. I just ignored his call because anyway, so, not that I avoid the paper, yeah. So, that's why I come to you guys direct with what I've been provided and can document and I share, because I feel that's how we all learn and that's how we become better and we help our fellow realtors. I'm the first one, if you call me, I'll come help you, I'll meet you, I'll do whatever, because I'm just going to share with you, I teach the Code of Ethics, and it is a thorn in my side that realtors are out of the top 13 of top professions, and we're below congressmen right now. And if we don't get up in that, I think I'm going to have a coronary attack. So the more professional we are, the happier that I feel like we all are, because our industry needs that boost of professionalism and knowledge, and this kind of stuff is what's going to set you guys apart and make us a better industry. So that's my little soapbox for today, and I'm so glad you guys are here to learn. So any other questions on the entitlement part? Okay, so continuing on this page, it says buyer at buyer's expense. In addition to any charges or expenses required in the contract to be paid, buyers shall pay at the time of closing, unless otherwise provided in paragraph 7. Do we write in paragraph 7 in your office, Angelina?
Mhm.
Do you write in paragraph 7 in your office? Or does your attorney do that?
And this former.
On any form? Do you write in special provisions?
Sometimes, but it's very little, like layman's terms typically if we do it.
But it's approved by the broker or the attorney, right? Yeah.
Yeah,
Because we,
most of them know better. They
yeah,
ask
we
me
don't
how to write
practice
stuff.
law. Yeah, okay. Anyway, everybody's
rare.
different, every brokerage is different, and I'm gonna tell you how to run your individual business. So you're gonna do anything other than what's paid here. You're gonna pay the first year's insurance or flood insurance if there is any. We didn't talk about flood insurance. So if the house has flood insurance, they've got to reestablish that or assume the current policy. And that's one of those that I feel is better to assume it instead of try to start over. And then the buyer's recording fees, any transfer fees not to exceed. And to me, you've got your paper. Sometimes you may not have these expenses. And so you might put all required. You might put to be determined. You don't necessarily know what that amount's going to be. If the buyer says, I'm not paying over X amount to do this, you're going to put that there. And any other loan fees as may be required by the vendor, VA, FHA, or the conventional loan. This doesn't address conventional, which bothers me a little bit, because most conventionals have that due on sale. However, there are some that don't. So, one thing if I were doing a conventional is I would put in special provisions, this is a VA assumption. I mean a conventional assumption. And all the above terms apply or something like that. Because everything in this up to that point references VA and FHA, and you don't want it to be unknown or undetermined. What's something else you might put here? Can you think of anything?
So I'm thinking like if you would do, since it's an assumption of a loan, you wouldn't have a regular, like conventional loan addendum or anything like that.
No, you're not going to have that.
So if you wanted like closing cost or something specific.
You want the seller to pay part of the closing costs, you would put that here. If we want an appraisal done, does it go on the base? No, it goes on the financing because it's part of the financing. So it would go in that paragraph.
What about the difference between the equity and what cash they have?
That's good. That part is in paragraph 1 because it actually says what the balance is, and then your main is your sales price. Okay, so this calculates it through there as you go through. The biggest thing on this that I feel like you've got to really put into play an explanation to both parties is whether it's a fixed sales price or a fixed equity. And I would just suggest, how many of you guys do an app for your expense sheets? How many of you guys do the long granny form? Okay, I do the long granny form, and let me tell you why I do that. And this is what I would suggest you do, is I would print off one of those long granny forms. It's 2 pages, and you can print everything off of the app. However, I would take what I've given you here today, and I would do an example of a fixed sales price and a fixed equity. And I would have those on my granny sheets, and I would keep those with me so that I can explain those, because it's going to be easier for you to remember all these fees we've talked about when you're looking at them broken out, and you're not going to forget to put the HOA on there, the this on there. And I would do 2 for the seller, and I would do 2 for the buyer. And I would have me a packet or a manila folder, or however you want to do it, scan it into your whatever, however you keep your stuff the best. I'm a paper person. Like I said, I'm a granny. You guys are probably techie, and it's scanned into your, you know, your laptop or whatever. However, keep those as your examples. Because that way when you go on that listing and you need to pull those up to do those net sheets, you can make sure that you don't leave anything out of the app if you do it. And if you're writing an offer, you don't leave anything out for the buyer in disclosing all the stuff that there's going to be. And the other thing it will do, it will prompt you to look for the things that are on here when you get those assumption packets or those assumption letters. And if they don't have something that we've talked about, it's the phone call, are we going to have this? Just make sure that you cover yourself and you give yourself a little grace in the padding on these figures, because you're always a bigger rock star when they come up with less as a buyer and the seller comes up with more. Okay? Uh-huh.
On the flood insurance,
Mm-hmm.
and I'll disclose, I'm a licensed insurance agent too, so I can tell you this.
Okay.
But I'm asking a question too in part. So I know as an insurance agent, it's not a required coverage, it's bonus. If it's in a flood zone, it's gonna be required.
Mm-hmm.
If you're doing an assumption, is it a requirement if it was in place, whether it was in a flood zone or not? Or is it a requirement for the buyer?
If it's currently on there, they're going to require you to do it unless you do the elevation, get that brought out of it. They will pull, and this is something,
FEMA?
notation, they're going to pull a flood cert.
Yeah.
So they're going to see if it's gone into a flood zone since that loan originated.
If
That-
it wasn't in a flood zone, but the buyer is one of those people that wanted flood insurance, so it was an option,
Then you wouldn't be
you wouldn't be
required
required.
to.
Okay,
I
that's
think
what I was
that's what
getting
you're
at.
asking.
Yeah.
So I know, I mean, the flood lines change all the time too.
Right.
So if it was in a flood zone, you know, when the seller originally had it, and then now the buyer is taking it over by the assumption, and it's no longer in a flood zone, are they required to still have a policy?
If they
Because
can
they
prove,
haven't before?
if they can prove that it's not, then they don't have to.
Okay.
You guys know where to look at flood zone maps? Where?
FEMA.
Where else?
And plus,
Where else?
County assessment.
Where else?
Yeah, I just already take one.
If you all don't say it, Jeannie, where else?
I'm drawing a blank.
RPR.
Yeah.
If you all aren't using RPR, get to my classes. It's the best tool that's out there that you're paying for in your dues money, and it will make you money, I promise you.
when's your next RPR class?
The 25th of August at 11 o'clock.
And they're also, the new realists that's being updated in the fall, will have it to where you can buy really in-depth flood reports. For like
It's in
$20.
RPR now.
Yeah, I guess it's like
Yeah.
super detailed for.
Yeah,
others.
the elevations are in there, the layovers are in there, it's phenomenal, and you guys are paying for them in your dues dollars. If you're not using that part of your business, it's costing you money. Yeah,
Question. Okay, for instance, out in Choctaw, they put the whole entire Whippoorwill Wood, the city of Choctaw, in a floodplain after 11. Do you remember what I'm talking about? Now, you cannot get an elevation survey for that to take it out because the city decided that would be more advantageous if they needed to go after FEMA funds. So how would that relate to if you had a property with a VA assumption?
if it's required, it's gonna stay required,
Okay.
yeah.
Because that's one area, I know for sure that's what they did.
Let me give you
in
something.
Oklahoma, in the area.
Okay,
I'm sorry, I have to leave.
that's okay. One thing before you guys run off, on your certificates that I've given you, you can put your name, your license number on there. The course number is 199224.
Nine.
224. Mm-hmm.
You say 119?
199224. Today is the
Seven. You just want me to leave this here, Pam?
No, it's yours to
Okay.
take, that's your certificate, I just wanted you to have that.
Okay.
So the flood insurance is one of those things, if a buyer that says, I've had it in the past, I know Oklahoma gets weather, I wanna make sure, they can add it. It's not required. They can't get rid of it if it's required. Uh-huh.
I just didn't know if it was like a requirement. Yeah, obviously you have to have it, but if it's not a requirement and it was in there previously,
Then they
does
don't.
the lender want it to stay there, or are they okay
No,
with
well, you
letting
may
it go?
have to do some convincing. If
Yeah.
they're in Vermont, they
Some
may not
proof.
get it. I
Right,
mean, I'm
right.
just saying, you may have to work through that.
Okay.
However, they're gonna pull that flood cert, and if it's not, then they will reanalyze that. And this is the biggest thing too, for your closing, if the buyer secures their own homeowner's insurance, they're going to reanalyze that escrow account. So the principal and interest is gonna stay the same, and you can get that from the seller. And you know what the property taxes are gonna be, and they get their quote for their insurance during their TRR timeframe, so you know on the front end what that's gonna be. So you can give them an idea pretty quick of that payment. Okay? And you can still be within your TRR timeframe of discovery. If that payment's not where they can be, you're still within your time frame on that part of it. Okay? Uh-huh.
We had been talking about the different options buyers had for coming up with the equity money.
Mm-hmm.
Was it just seller financing, or was there more to elaborate on?
Well, you have the seller could carry part of the second. They could do private financing. I mean, there's banks, there's credit unions, there's individuals that will loan money at a certain rate for a certain amount of time that's not necessarily a bank. There's the mortgage company that I gave you. I'm sure there's some others out there. Like this is an old new that's gonna retrain a bunch of people that haven't ever done them. So when you have a lender right now that you may be using on some things, and you call and say, can you do an equity second, or can you do a second mortgage? They're gonna go, huh? Well, you know, some of them will do a 20%. They want a 20% LTV, so they want the buyer to pay 20% down. Some of them don't have a percentage they want them to pay down. Some of them want them to have at least a 5%. There's going to be some terms there. If you look at the seller page that I gave you, on the financing, you have seller carry by amortization. You have a balloon. So say that the buyer is coming in and doing an equity, and they're selling their house in Florida, and it's, you know, they don't want to put it on the market yet, and it's going to be 6 months or something like that. You could do a one-time balloon in 12 months, 8 months, 9 months, something like that, and the seller's carrying it with a one-time payment. And then you've got it where they amortize it out and pay, and then it balloons. So you have some options that the seller might offer, and some sellers may say, I don't want to carry it at all. Or they may say, I do a one-time, as long as they put X% down. It's going to require us to have a little bit more of a relationship and some trust and engagement with our sellers to do these kinds of loans. Because they are going to have to understand the process with that. Now there's another form. What did you run a while ago?
I did the
Seller
seller
finance.
The seller finance, I'm sorry, I thought I got that one in there. This is just one that says supplement. And you know, at the top of our purchase contract, there's these little things that says a supplement's attached. If you do a second mortgage, I would suggest that you use this form and say buyer will be obtaining a second mortgage. Because you don't have anywhere else to put that except for in the special provisions. And this is a supplement. So you can mark other and put supplement in that blank. And you can put they'll be obtaining a second mortgage at a rate not to exceed X amount on here. Now you might want some guidance from your broker on what they want you to put on here. And it may just be subject to buyer being able to secure a second mortgage, period. And not go into details. However, we used to have a form that said second mortgages and some of those, and I've asked Adam at Oakmar to look in the archives and see if he can find that second mortgage in some of those forms and bring some of those. We got rid of them because we weren't using them. And see if we can find those and bring some of those back to surface because they're relevant now. However, there is this form that you could put that's subject to them obtaining that second. Okay? So we've talked about the assumptions. We've talked about the seller finance, our listing questions, our VA. Have I scared you guys to death?
The majority of them invest in real estate, so probably not.
Okay. However, it's a whole new conversation now when you go on that listing, right? You've got a whole new arsenal of opportunity to work with. Now, can an investor assume a loan?
Yes.
Yeah.
As long as they live in it?
Some of them they might. However, when you go on that listing appointment and you get that authorization to talk to that lender, or you call, ask, does it have to be owner occupied? So one of the questions that we need in MLS, does the assumption require owner occupied, yes or no? What type of loan is it currently? Da-da-da-da-da-da-da-da. All of the loans.
Would that be in the mortgage?
Huh?
Would that be in the mortgage?
Sometimes, however, I would suggest asking the lender, because that way you're not trying to interpret that document. Because if you try to interpret it and then you tell them wrong, then they're going to say, well, you told me I could do this. So I would get it from the lender through the assumption package. Can an investor buy this property as long as they qualify and, you know, make it a rental, or does it have to be owner occupied? Yeah. And some of them, to be honest with you, on the FHAs, they didn't require those to be owner occupied. Now, it did initially, and we're getting into this again. The mortgage says that it's owner occupied. However, how many people turn them into rentals?
Right, what's that gray area? I mean, I know what.
It's going to be up to the lender to tell you.
Okay, so that would
Because
be the
they're
traditional-
processing the assumption, and they're going to ask, is it owner occupied or no? So find out on the listing front end, does this require an owner occupied? A lot of them are going to because of history. And that's just, you know, what it is. So I'm not going to tell you yes or no, because as soon as I do, you're going to call one lender and they're going to say, we don't care. And another one's going to say, the mortgage says yes. And so that's why I say ask those questions when you list of that lender that you're working with. And this is my suggestion to you. When you call those lenders and talk to them and you get that authorization, ask their name, if they have an ID number, if they have a direct extension, and you make a note of that, who you talk to, the date and time you talk to them, and you keep it in your permanent records. Because they made a note that you called in, you keep a note that you called them and what they told you, and say, can you email me the documents to support this? Whatever you need to be able to function that assumption and make it happen. Because that way you have that who you talk to go back to. If the next person you talk to says, well, no, you can't do that. Well, Judy told me I could on this day at this time. Can you look at the notes in there? So we may have a little bit of that at the first. And most of your loans, now there are FHA and, there are conventional loans that were created as investment property with a 20% down on the front end. So I don't know if they have a due on sale clause. If those are assumable, then they're an investment loan to begin with, and they probably aren't going to require an owner occupied. So those are the questions that you have to get those answers from the lender, because they ultimately are the ones that are going to approve it.
Does the lender have the right to adjust the mortgage after assumption?
Not the principal and interest.
But change the verbiage on
No.
add something into it?
No.
That wouldn't make it assumable, it'd be an
No.
adjustment,
The mortgage, what it is at the time that it was created is the way it is. Those terms don't change. Okay? What are some ahas?
And it can even get done.
That it can be done, yeah?
For me, it was just that 40 people agreed that this is maybe gonna be a thing soon.
It's a thing already.
Yeah,
Yeah.
I had
And I'm excited to have you guys and others learning it, because I just think it's gonna help all of us when we start seeing it in the MLS and the data being there where we can utilize it for the benefit of the buyer and the seller. Because it really can net the seller more potentially and put more buyers back into the market.
Yeah.
Because they've gotten a little gun shy and stagnant. However, there's still money. They still have money. So let them spend it. Yes?
Prior to 2020, when the interest rates dropped so low, interest rates were around 4, 3, 4, 5, right? And I noticed on the MLS, there is that spot where it says assumable. I never knew what that was and never understood it. So this has probably been a thing all along. It's just now it's more advantageous because of the lower.
It's never not been a thing.
Yeah.
It's
Been around for
just when
years.
they went to 2.5, a 4 wasn't pretty.
Yeah.
Yeah.
But this is the thing I want you guys to think about too. If you go on a listing that was 7 or 8 years ago, I'm just going to throw it out there, and their interest rate was 5.5%, what'd they pay for that house? That payment is still going to be lower at that 5.5 than them paying today's price at 5.5. And if the buyer has the equity to pay for that 5 to 10 years worth of equity that seller's done, why would they not? We've got people selling houses all over the country coming here with $100,000 to $500,000 in their pocket and not buying because they don't want to pay the 6% rate and they don't want to spend all their cash not knowing what's going on. Would they spend $200 or $300 of it and have a 20-year balance, only owed for 20 years on that house, and have their equity and have money in the bank? It's a win. So just because that mortgage is 10 years old, don't hesitate to ask the seller these questions. We haven't been in the habit of doing it because we haven't felt like we've had to. It's been easy to sell the 2.5. It's been easy to get them qualified somewhat. It's still easy to get them qualified with a much lesser payment.
I've got a question.
Mm-hmm.
So, say you have some buyers that they have handful of cash. They
Mhm.
sold a house or whatever, and they have money for possible equity, and they're going on MLS. You know, hey, I want to look at this house, but assumable is not checked. Probably because the agent didn't ask or the seller didn't know, and they just
The
said,
questions have not been asked.
no, let's just skip over it. How would you approach that listing agent to maybe see if that's an option?
How would I do it? What I first.
Or would you?
Absolutely, I would. And what I probably would do first with that was I would look in RPR Realist. I would look and see what type of mortgage they did,
Right.
how much it was, and the type, because it's going to tell me that. And then I would call that listing realtor and I would say, I'm calling about your property at 123 Main Street. I have a potential buyer that's interested. They would like to consider an equity assumption. Do you have any of that information available I can share with them?
No, what's that?
Yeah, exactly.
Okay.
That's gonna be the next one.
What that is we would like for you to contact the seller and find out what their unpaid principal balance is, how many years are remaining on the loan, and what their interest rate is so the buyer can consider making an equity offer on their property.
So there's benefits to the seller. Is there a change in benefits to the agent?
Other
It's
than
just on
you
the
can
sales
get them,
price.
other than you can get them in a property,
Right.
and they can have a much lower payment potentially than what they can go do
Well,
now.
I'm thinking the listing agent, but I mean, they're gonna get paid on
What
the
they're
sales
gonna
price.
say is, well, why do you need that?
Yeah,
What difference is that gonna make?
well,
Well,
my buyer's in a better position.
what I would say to that is, if you don't have that information, could you go to your broker and ask them, or I'd be happy to help you get the information, so maybe we can work a cross-sell together and we can make this thing work for both clients.
I've been doing this for 20 years.
No, I
Yeah.
don't pull that card.
No.
Yeah, because the minute somebody does that with me, I'm like, oh, really? Okay, yeah.
Is there any resources you recommend to go, because I like to read, study stuff. 2 hours is great, but is there any additional resources that I can go and?
You can Google equity assumptions. You can look at some history of how we got to where we are. You can look at a VA equity assumption. I mean, yeah, you can go online and Google those. There's all kinds of people that are going to tell you different things. Some of it can be really confusing, and a lot of it will just answer kind of generic the way that I've done it. It's not going to give you a bunch of detail. They're probably not even going to tell you the questions to ask the seller. I did that because I feel like that's the best ammunition you have in winning that listing and being knowledgeable on the front end of how to do that. And like she said, you're going to have a lot of kickback. We have, 7,500 people in MLS, and we have 3,400 of them that have sold a house in the last year.
Yeah.
Okay, so you get that person that's on list, and I'm not picking on anyone. You get somebody that just got their license and has their first listing.
Yeah.
They're not going to know the answer to those questions because they didn't learn that in real estate school. They didn't learn it in the finance section. And and their broker may have only had a license for 5 years and may not know. So what I would say is, can I help you do that? I'd be glad to assist you and tell you the questions we need answered to be able to do it. You're probably gonna get some kickback with it. You can, the buyer can write a written request to the seller for the information. Do we have to present all offers? Buyer requests this in order to look at making a potential offer on the property. We want this information. I mean, there's ways to do it and be nice and helpful and not make the other person feel like a total idiot. I mean, and I mean that in a nice way because it is a huge learning curve. Now, if we were in the 80s, everybody knew how to do them because that's just what we did. We paid that $45 and we got title work done and we were closing in 3 weeks and we were doing 8 to 10 of them at a time because those equities were out there. And it was costing them $4 grand, $3 grand, $4 grand to buy those houses at $45,000 to $50,000. And they were loading up their arsenals of it. Just like investors are loading them up with things today. However, the investors, some of them weren't very smart because they paid cash for everything instead of doing these equity assumptions for the last year, 2 years. They should have been doing those and using their money a little more wisely, but they didn't. However, they didn't do them that way. So, sorry, it's my kiddo. Any questions?
So on the FHA assumable,
Mhm.
you know, in the article that Richard Mize wrote, it said that those follow the seller as well. But do those actually get, as soon as the assumable happens, it goes in the new buyer's name?
Yes, so on the FHA, it goes in the new buyer's name. You have, do you guys know the difference in MIP and PMI? There is a difference. So on an FHA, you have MIP, and that is what the insurance that goes along with that to pay if there is a deficiency from a foreclosure on it. The seller gets a full release of liability. That's what the contract says, that they'll provide that within 30 days.
Okay.
So yes, they're fully released from that loan. They're released from each one of them because the buyers come in and they've qualified the same way the seller did. The only way they're not fully is the VA if they don't do the entitlement. Okay?
And that's where when I was reading that, I was like, I'm pretty sure that when I took Jeff Elias's class, he said that they were completely released from.
They are, and that's what the contract says, is you'll provide that release of liability. And
But some of
that's the
those-
fully being approved.
But some of the ones in the 80s did follow people, correct? Some of the assumptions in the 80s would follow people.
Yeah, because they were simple assumptions,
Yes.
and you didn't have to qualify. So when all those people collected all those rents and didn't make those payments and went to jail, yeah, there were a bunch of them, I can give you some names. They went to jail because they collected rent and didn't make payments. The people that got left holding the bag were the original note people. And that's why this changed in 86 to 89.
Okay.
So yes, that's the way it used to be on a simple assumption. These are a formal qualifying assumption. It's 4 o'clock. I like to start and finish on time. If you guys, does everybody have my phone number? Is it on there? I'll give you my phone number. If you have any questions, call me. I'll be glad to help you. It's 405-833-5005. And I won't chew your head off. I love to help, so feel free to call me anytime.
So quick question.
Yes, ma'am.
DTI is the same, correct?
Your debt to income ratios are going to be the same, yes. So your conventional, your FHA, your VAs, we know those can go a little bit higher on some of those. But yes, those are you're going to have the same qualifications that you would have doing just a regular loan.
And
Good
so
question.
Right now they're paying 20, now they're buying up points on 700 schools.
I know, they're buying down points. Why would you buy down points when you could go buy an equity at 2%, 2.5%?
That's the most insane thing, 700 plus score, 75.
So the buyers have to qualify at the current qualifications or what the qualifications are when they got the loan papers, when the sellers got the loan papers?
It had,
Because I know
well,
debt to income ratios change.
they're pretty much been the same for,
Okay.
oh, yeah.
Just
Yeah,
checking.
they're 29 and 41 on a VA, and they can adjust, you can go up to a 45 on an FHA, depending on their credit score. And then you're about a 34, 36 on a conventional. And you can figure those if you know how to do them. We used to have to figure those ourselves, and everybody in here should be able to come up with how they do those. That's another class for another day. So anyway, I've enjoyed being here. I want to thank you guys for coming and attending, and feel free to call me if you have any questions.
Thank you, ma'am.
Thank you very much.